It does take us to our talk of the tape. The rebound gaining even more steam today. So let's bring in our panel to discuss. Adam Parker is the founder and CEO of Trivariate Research. Joe Terranova, chief strategist with Virtus Investments, and Alicia Levine, head of investment strategy at BNY Wealth. Excuse me, Joe and Adam, CNBC contributors. All right, Adam, I turn to you first. We're back. We're back. Like you were growing more cautious, I felt, by the day, if not week, and here we are. This is unbelievable.
You know, it's great to be alive. It's beautiful outside. I'm with you, wonderful people. The market's ripping. I mean, this is our moment, right?
You're a happy American.
Yeah, I mean, this is, God bless America. Exactly.
Were you wrong to be that cautious? After that preamble, you opened the door for me to ask you that. I mean,
I don't like to. I'm not like a victory lapper. I think in our second half outlook, we got more cautious, and that was probably lucky. But if you look at the data, the consumer is worse. I get today's retail sales data is better. Walmart is a different entity. It's a $600 billion revenue company that's, so I wouldn't use that as like everything else is fine.
No, but what do you mean worse? Worse than what?
The consumer is definitely worse than people thought on July 1st, and it's definitely slowing. I don't need to look farther than restaurants, travel, housing, autos, or Visa to get data points. Yeah, but for every Brinker, there's a cake. Or, there's another stock.
Sure, but for every McDonald's, there's a Shake Shack.
Sure, but the aggregate consumer in dollars has slowed, for sure. And my view is the world's changed. Every growth manager in the world would say, I use momentum. Every value manager in the world would say, I look at mean reversion. I think it's going to be the opposite for the rest of the year. I think growth managers are going to use mean reversion. They're going to buy these things up. When they get to some level below where they peaked before, they're going to sell them. I don't think people are walking in today as a growth manager, big fund, saying, I love NVIDIA more than I've ever loved it before, and I think it's blasting to the moon.
But you're not not moved in any sense by the fact that where we were a week ago Monday to where we are today.
No, I think it's been a strong rally.
And the inflation data, and now the economic data. This is not a warped view of what's happening with the consumer. I mean, I understand there are obviously two ends to the consumer.
Sure, you don't get 100 consecutive data points in the same direction. We got a couple positive, but I think there's 60 negative and 40 positive right now. It's not 80 positive, 20 negative. At least that's how I'm looking at it. I think the rally got a little sold off a little hard on some fear, a carry trade, other positioning things. As we kind of get toward where we were, I think people are going to sell some of the growth stocks. I do. I don't think it's straight to the moon. You saw a pretty big rotation in real estate and banks and healthcare services and housing before the sell-off. So I think the market was primed for a little rotation anyway. So I'm not like bared up. I think the rally's great. Our view has been same probability of 10% upside as 10% downside. Got a little more cautious during July because the data got worse. Today's a good day. I agree, but I don't think it means all clear because I think the earnings estimates for Q4 are too high. So the way institutional investors work is they go on vacation. They go to the Hamptons, they go to the Cape, Nantucket. They come back after Labor Day, and they hear the big conferences, Citi Tech, Morgan Stanley Healthcare, Consumer, and they're going to lower the numbers for Q4 in 2025. So I think you have a pocket of, everything's wonderful here, but the estimates have to come in for Q4. That's my view right now. So I think risk reward is not amazing at the current moment.
Okay. I don't know that, that
might not be out of consensus.
No, I don't know.
Might not be
I don't know because look, Rick Reeder, Alicia, sat on this desk the other day, too, and where he was pretty bullish during the sell-off a week ago Monday, he's a little more cautious now, too, because of the run that we've had, the fact that the Dow's now above 40,500. The NASDAQ is up 5% week to date. So that makes people like Rick and Adam obviously take pause. What about you?
So, look, we did not change our positioning at all, even given the Labor Day, the August 2nd labor force data or the sell-off on the Japan yen carry trade. We never changed our positioning. I will say there is evidence that the economy is slowing, and the Fed probably has room here to cut 100 basis points because real rates are simply too high, and you're feeling the squeeze at the bottom end of the consumer, and it's moving higher. So there is a bit of a race here for the Fed to get going on this. But having said that, we think the market ends higher into the end of the year. We're confident on earnings through the end of the year. We still like U.S. large cap. I think I'd add to that here, financials always outperform when the Fed cuts into a soft landing. It looks like we're going to get that. So, yes, do you move away from large cap tech? Of course you do. So you go into REITs, you go into financials. That looks great, too. And I think the cyclicals can be OK here.
So you don't think that earnings estimates for the fourth quarter are too high, like Adam does?
No. I don't think they're too high. I think the earnings estimates actually have been moving higher. And yes, people go on vacation, but they're not brain dead. And so I think it's been a very good year where earnings have come in better than expected, and earnings are moving higher for this year and next year. And if the Fed sticks the landing, we don't see why that can't happen. Now, technically, the S&P went through that 50-day moving average, which was acting like resistance, and went right through it this morning. So I think we're looking good for now. So you say to me, so what could go wrong? Well, what could go wrong is, you've got Jackson Hole, you have other data prints ahead of you. You've got another jobs print in September. And so that can be bad as well. This morning was about as good as it gets, since everybody had moved in positioning from no recession, Fed's going to stick it, to there's a recession coming. And so now you're just moving back to the middle there, where there's a two-sided risk rather than the one-sided risk that we basically had going into the end of July.
I feel like, we have a little bit of delta in the views between Alicia and Adam.